I came across this article here on Seeking Alpha titled How to Invest $100,000 for a High Yield Monthly Dividend Portfolio. And the article was written here from Brett Ashcroft Green. I thought the article was pretty good. He touches on a lot of things that resonate with me. And it really is, if you had $100,000, let's say, for example, you sold a rental property or you got an inheritance, or you sold some of your growth stocks or your Bitcoin or whatever it may be, and you were looking for monthly dividend income, I think Brett does a really good job in explaining some of the options that you could consider. And some of the ETFs that he discusses in this article, I invest in myself, and I think he does a good job explaining, his idea around having a conservative portfolio that's generating monthly income. I am so excited to share that today's video is presented by Snowball Analytics. Snowball Analytics is a tool that I use to track my dividend income and analyze my portfolio. Whether you're a new or existing Snowball Analytics user, use promo code DGI to get the very best pricing. So the article here, the summary is monthly payers like DIA, JEPI, JEPQ, and SPHY provide consistent income, making them attractive for income-focused investors. DIA offers exposure to the Dow Jones Industrial Average, balancing growth and stability. JEPI and JEPQ generate premium income through option strategies, enhancing yield potential. And SPHY focuses on high-yield bonds, offering higher returns from increased risk offset by nearly 2,000 holdings. And a monthly paying setup could be a good alternative to a rental property. So let's take a look at the article. If I wanted to button down a slice of my portfolio for monthly income, what would I buy that could provide a balanced fund strategy, achieve both low cost in terms of management fees and an underlying holding structure that I would be comfortable with? These are questions I have been pondering. Now, this hits the mark for me because he's not talking about, building a portfolio of 10 or 20 individual stocks. He's focusing only on ETFs, and I really like this. I think if you're trying to downshift from being an active investor into real estate, you probably don't want the headaches that come with that. You want to make it more passive. And so you don't want to trade one active job, a DIY real estate investor, to actively managing a dividend portfolio of 20 or 30 individual stocks. I really like his approach, and I think it can apply to a lot of maybe older investors or those of you who have already accumulated wealth and are looking to maybe transition into a slower pace and you want to take some risk off the table. I think an approach like this can serve you very well. And I'll just give you an example. My parents, they're considering selling their home, and what are they going to do with that money? This is an approach that they absolutely would consider. They're not going to go and buy 20 different individual stocks, but they may invest into a handful of high dividend, monthly dividend ETFs, right, that have low management fees. So this can apply to a lot of people. And it's not just, if you're selling a rental property or real estate, it could be if you're working your 9-to-5 job and you want to replace your active income, you could do this, brick by brick and build up to $100,000. It doesn't have to just be one approach. But yeah, back to the article. If you're like me and also have some rental properties that you may be looking to part with, placing those funds into a monthly paying strategy would be an easy adaptation to continue on with monthly expense planning. Getting rid of the repairs, the tenant drama, and lack of liquidity of rental properties might be something that would relieve a lot of headaches. And this really speaks to me because that's exactly what I did. If you know my story, I sold 2 rental properties in Austin and transitioned the money from that into my dividend portfolio. So this really speaks to me. This is exactly how I did it. And I think it's a great way, you put in the blood, sweat, and tears, and then you make that transition. I think it's very common. I mean, not everybody wants to be a landlord in retirement or landlord forever. It's not for everybody. So moving on, although I am only including equity and high yield bond funds in this instance, monthly paying REITs like Realty Income is not a bad choice either. I own my fair share, but no longer regard it as a screaming value. It also lacks diversification, being a single company. Therefore, I eliminated it from consideration here. REIT funds were good for the snapback trade, but their dividends tend to not grow over time like a single holding REIT would due to the churn in the top 10 of the indices they follow, rotating in and out of REITs with higher or lower yields. based on market cap. I'm not a big believer in bonds. Warren Buffett and Peter Lynch both advocated staying away from low-yielding bonds, especially U.S. Treasuries that underperform equities significantly over time, somewhere to the effect of 5% underperformance, compounded over decades. That amount, the amount is staggering. So over the long term, stocks do better. Since 1926, large stocks have returned on average of 10% per year. Long-term government bonds have returned between 5 and 6%, according to investment researcher Morningstar. As an example, below are a couple of simple compound interest tables comparing a 30-year 10% CAGR annual growth rate versus a 30-year 5% CAGR. So this is the miracle of compound interest. So the example that he's giving here, if you were to invest $10,000 at a 5% CAGR compound annual growth rate, it would grow to $44,000 in 30 years. Alternatively, if you had a 10% CAGR, it would grow to $193,000. So about 4 times higher over a 30-year time period. And that's the miracle of compound interest. Although it seems like a mere 5% difference, keep in mind that this statistical data is always dealing with compound interest rather than simple interest. The return of the latter versus the first example is on the order of 4.35 times greater over long periods of time. While 30 years may be well beyond many of our time horizons, directions to a trust to perform a simple or similar setup can change your family lineage forever or benefit your charity of choice should you not intend to extinguish all of your savings in your lifetime. So now looking at his portfolio, if you had $100,000, he's saying to equally weight into these 4, the SPHY, DIA, JEPI, and JEPQ. And if you were to do so, you would have an average yield of about 6.5%. And they're not all equally weighted. They're not all growing the same. But because they are equally weighted, you can take the simple average, and the simple average is 6.5%. So he's going to take a look at DIA. So DIA, first off, the Dow Jones Industrial Average, DIA is the lowest yielding of the bunch, and its intention is more capital appreciation than it is yield. It is also one of the only large cap equity funds that I'm aware of that pays monthly rather than quarterly. That's not the case. There's actually quite a few dividend ETFs that pay monthly. There's a few from Wisdom Tree, like ticker DTD or DHS, for example, that pay monthly, but you will have to pay a higher expense ratio. It'll still be lower than many others, but it will be higher than DIA. Okay, but there are a few out there, and you can use the stock screener with Seeking Alpha, and you can filter by, the dividend in terms of the frequency, monthly or quarterly. So there's a few out there. Most of them do have a higher fee, but the ones that I do like, they do carry a higher fee, are the Wisdom Tree ones, DTD, DHS, are just a few that I like. And, another one is DGRW, right, from Wisdom Tree. Like DGRW would be a great alternative to DIA. And like I said, a little bit of a higher expense ratio, but there are some out there. But moving on, it is also the only constituent of the bunch that should have dividend yield appreciation over time. Okay, so this is well demonstrated by the nearly 30-year yield on cost line, and where investors are now enjoying a yield on cost of nearly 10%, along with the appreciation. Most buffered call overlay strategies that pay monthly income in tandem with their separate equity holdings can provide capital appreciation but lack the ability to increase yield over long periods of time. DIA fulfills that void in this strategy. So what he's actually doing here with adding DIA for the quote-unquote capital appreciation, it has a lower yield and the dividend growth, I actually like DGRW more than DIA. So these are the holdings that he has here. I think DGRW would fit better in this type of portfolio. Or, you could add it, instead of doing 25%, you could do 20, 20, 20, 20, 20, right? And you could equally weight it that way. But I think DGRW would serve a greater purpose because he has DIA in here for the purpose of capital appreciation and the dividend yield appreciation. And so for that, I think DJRW would be a better option. But that's just my opinion. And with fewer stocks in the S&P 500, the top 10 in the Dow 30 is more concentrated at 58% versus 35% in the S&P 500. However, the top 10 in the S&P 500 is now concentrated heavily in tech stocks, while the Dow is very diversified amongst other sectors. The top 30 holdings are price weighted versus cap weighted or market cap weighted, so it rewards constituents that do fewer stock splits and maintain higher share prices rather than the actual market cap weighting. While several pundits and fund managers have regarded this as a silly index composition, I also agree with that, it still follows a momentum-based strategy. If share prices don't rise, then stocks on the list will not make it into the top 10. Just think if Berkshire Hathaway ever made it into the Dow, it would have made the Dow 30 the best performing index of all time. Secondly, a cost-weighted index also allows an investor to match the index by buying all 30 shares by one by one. This was a very simple approach before equity ETFs came to the market, with the average mom and pop investor may have wanted to buy stocks themselves without having to do a ton of research and still have the strategy well within their financial means to execute. A 500 stock S&P 500 market cap weighted index would be near impossible for the average investor to replicate. Yeah, really, really great point there. Let's see here. So moving on to JEPI and JEPQ. If you take a look at JEPI here on the graph here, JEPI is yielding a 7.5%, where JEPQ is yielding just under 10%. If you combine them together, you get an 8.4% yield. I like this. I like looking at this, looking at it from this approach. A lot of people in my, in the comments of my videos, they'll always write, well, what do you like better, JEPI or JEPQ? I like both of them. And if possible, I would add both of them because they're casting a wider net, right? And just think about it when you go fishing, right? If you throw a small net, yeah, you might be able to catch more of a targeted amount of fish. But if you cast a wider net, you're gonna have the potential to get more fish. And maybe that's a bad example. Maybe it's not. But the analogy of casting a wider net, I still like, because these two ETFs focus on completely different indices, and that's why I say casting a wider net. You're getting one with the S&P 500, one with the NASDAQ, which he'll get to here in a second. But a lot of people ask me that on my videos in the comments, and I always try to say, why not consider both? I like both of them. So now let's take a look at JEPI and JEPQ. They have driven me up the wall contemplating how the ELN cover call overlay strategy produces the monthly premiums. Okay, so this is really, really important. He does a good job at explaining the ELN strategy, because it's not quite as straightforward as some of these other cover call ETFs, or if you were to do it yourself. So he writes here, I understand that a large part of the total returns is not just the call premiums, but also the active management from the perspective of the manager selecting the stocks within the target index to provide capital appreciation. As the dividends from the stocks are paid out along with the premiums rather than reinvested by the manager, the price return of the stock portion of the portfolio, which has a target of 80 to 85% of the portfolio, is probably the most important part of the strategy. Back to that in a minute. I also like to thank the investor relations desk at both JP Morgan and Invesco, who I chatted with a few times regarding how ELN structure works. Now I don't expect anyone other than the manager, Hamilton Reiner himself, to completely understand the functionality of the ELN call strategy, who I did not speak to, but my research suggests it is quite a bit different than a typical cover call strategy that an individual investor executes. In a typical covered call, we would write a contract with a strike price higher than the current price. We own the shares, and the purchaser of the contract pays a premium to us for the right to buy those shares for a certain price within a certain time frame. If the price never reaches the level, you keep the shares and the premium. If it does reach that level, you get called out of your shares at the contract price and are left with the cash, which would be less than the market value of the stock, and the premium. If an ETF did this, they would need to recalculate the NAV, the net asset value, every time they were called out. That is such an incredible definition. Like, kudos to him for so clearly describing that and explaining that. If you invest into JEPI and JEPQ, reread this paragraph here and internalize that and understand it, because JEPI and JEPQ are very different than a lot of other covered call ETFs out there. And it's very, very important that you understand this. This is also the unique selling point of JEPI and JEPQ is their ELN strategy. So the ELN, on the other hand, the equity linked note, is in note form, for more simplicity, a loan to the counterparty. So a chunk of change would be loaned to the counterparty and put the ETF manager and the note issuer into the arrangement for a length of time with a maturity date. Here's a diagram with my understanding. So he wrote here an ETF and a counterparty, and the arrows left to right from note to cash. ELN is sleeve to right synthetic future options based on index. Okay. So now I want to emphasize that this is purely my understanding, not from any JP Morgan prospectus, other than the confirmation that these are in note form, meaning that it is a loan. My understanding is also that the options are written on a weekly basis, so that the establishment of this ELN loan gives the two parties a sleeve in which to operate, with most likely some bespoke agreement with the counterparty on premium values within a volatility range for the duration of the note. This should give the ETF more certainty than actually trying to sell these things at the premium they want weekly without the assurance of A, someone willing to pay the premium ask, and B, a guaranteed counterparty for the transaction, which is much larger than normal contracts. I assume such a structure can only be pulled off by larger institutions that have those kinds of relationships, and I've finally become more comfortable with this as my understanding grows. My only question would be, does the principal repayment amount change based on the number of times a weekly call is called out within the ELN sleeve? And so he puts in here the definition from Investopedia, how ELNs work, and they give an example. So let me read off the example here. So in the simplest form, a $1,000 5-year equity linked note could be structured to use $800 of the fund to buy a 5-year strip bond with a 4.5% yield to maturity, and then invest and reinvest the other $200 in call options for the S&P 500 over a 5-year life of the note. There's a chance that the option will expire worthless, in which case the investor gets back the $1,000 initially put in. If, however, the options appreciate in value with the S&P 500, those returns are added to the $1,000 that will eventually be returned to the investor. So it would seem that the above example, the funds would be distributed into a strip that is worth $800 at the outset and worth $1,000 at maturity. The extra $200 at the outset is also allowed to be invested into call options, profit taken if the calls are in the money. In the case of pure call option ELNs, the premiums seem to be paid currently by the counterparty and the principal value possibly eroded, allowing the counterparty to pay back less when the maturity occurs, depending on the number of callouts. Again, ELNs appear very flexible depending on their terms. There's a ton of nuance of other things that can be worked out, like participation rates, and I'm sure that larger institutions can structure those better than small ones. I mean, yeah, JP Morgan, kind of a small institution, I guess. Two things are that A, this structure appears to be a very secure covered call setup, and B, the manager can control premiums better with a set partner. So this is a very different strategy than just a mom and pop shop or you doing it yourself on your portfolio. And I guess JP Morgan here, they're benefiting from economies of scale, right? Their partnerships, their relationships, and their size and everything. While both are actively managed, JEPQ seems to adhere more to the NASDAQ 100 format with nearly 98 holdings and a similar top 10. JEPI is more of a value-oriented fund with fewer holdings than the S&P 500. While both use the underlying future index of their target to run the cover call strategy, the stock holdings, especially in JEPI, have a very proprietary selection strategy. I myself am more of the opinion that we will see a reversion reversion to the mean in value stocks, and I like JEPI a lot at this juncture. Both funds have a mere 0.35% expense ratio, which is very cheap for active management. Although the ELN call strategy still befundles me a tad, I'm very comfortable that it is limited to 15 to 20% of the overall strategy, and there is no leverage in this strategy. So yeah, I think he does a really good job at explaining that. It is a very complicated topic, and it's complicated because they're not as transparent with their ELN strategy, because it is, and I don't know why that is. When there's not transparency, people automatically assume the worst, and I kind of view it like, Domino's, or any other, like Coca-Cola not disclosing their recipe, right? Because it's what makes them great and special and unique. And I'm only assuming that that's kind of what they're doing. So, and it is an actively managed fund. They are compliant in terms of, disclosing information that is required by the SEC, but this is a piece that is a little bit gray, and I think that they're using it to their advantage. But that's just my opinion. Now let's take a look at the last ETF, SPHY, the Spider Portfolio High Yield Bond ETF. Now, I've actually never looked at this ETF. It's pretty interesting. Let's take a look at it. So regarding bonds, both Peter Lynch and Warren Buffett have invested in high yield investment grade bonds before. Peter Lynch noted that he had a junk bond specialist for one of his charitable trusts, and Warren Buffett made a very large junk bond trade in 2002. He's also a fan of preferred equity and convertibility that pay large coupons while Buffett waits for the company to recover. Peter Lynch, for instance, recommended as a rule of thumb never to invest in U.S. government debt unless the yield is at least 6% greater than the dividend yield of the S&P 500, with SPY currently yielding 1.21% and the 10-year at 4.1%. The current spread is only 2.89%. The 10-year would have to go to 7.21% to meet the criteria. If that ever happens, it would probably be due to a hyperinflation event combined with a possible short default in interest payments. Not highly likely. State Street's high yield bond ETF SPHY fits all the bills of what I'm looking for in a monthly paying high yield bond fund at this time. First, let's look at the yield versus history. The title junk bond is kind of like off-putting for me. Whenever I hear junk in terms of what I want to buy, it's like, okay, it kind of makes my stomach turn a little bit. But we are currently at the tippy top of the 10-year yield, which is a combination of both credit spreads and a dip in the price after interest rates hiking cycle starting in 2022. So yeah, you can see the yield. The yields are at a decade high. Okay, that's good. This is also well demonstrated by the yield on cost with a 0-year being higher than the 10-year. This is an excellent entry point, okay? What I really like about the high yield bond funds versus the high yield private credit plays is the duration. The yield to maturity in this fund is 4.8 years on average, while many private credit funds have primarily floating rates. Rates float both ways. With rates falling, fixed rates are now going to be superior over the next 5 years. Also, these are simply an index fund of corporate debt rather than private companies for which we have no way of investigating their credit profile. Interesting. With this fund, annual due diligence is within the grasp of the investor. With private credit, we are simply putting all of our faith in the due diligence of managers. So the difference here is when he's talking about with private credit is companies that are not publicly traded, right? They're not releasing annual reports to the public. They're not being regulated, I guess, in that as heavily as publicly traded companies. And you can invest into both credit of private companies and credit of publicly traded companies. And he's making the argument here that, yeah, you're getting risk, you're having risk on both sides, but at least with this, you know what you're getting, and there's not going to be any or not as many gotchas in that sense. And you don't have to take a leap of faith on the due diligence of the people because of the people managing the private credit because they're not publicly available, right? And so I like that argument and that the way that he's looking at that, it resonates with me. The fund follows the ICE Bank of America US High Yield Index and has a 0.05% gross expense ratio, which is very low, and has just under 2,000 holdings. Each holding is about 0.3% of the portfolio or less. The top 20 corporate bonds include household names. So when you look at it from that perspective, I actually do like this. And, even if you were to have a widespread disaster or catastrophe, the fund is so well diversified and you don't have over concentration in one single sector or company. It's very well diversified. And I actually kind of like that. I think it's definitely interesting. I'm going to take a look at this ETF in more detail in the future. This is not something that I've really had on my radar. And it's something that fits the bill for me. It's a well-diversified ETF, very low expense ratio, and it has a high yield. Maybe I make a video on it. It's pretty interesting. So in conclusion, this is a strategy I would especially like should I sell a rental property to replace the monthly income that I was used to. I believe it covers all the bases of equities I like as the underlying holdings and high yield bond strategy that I am more comfortable with than private credit BDC names at this time due to their floating rates. The risks, of course, are buying in too high. This is especially true with the quartile represented by DIA, which probably represents the biggest depreciation risk in a pullback. However, since DIA as a monthly payer also has annual dividend growth, it will make up for any reductions in yield that the covered call overlay or high yield bond funds experience in future years. So that's the article. Let's take a look at some of the comments. Let's take a look at the first comment. Pretty good split for dividend and growth. I have a number of closed-ended funds, CLOs, and bond funds as well that boost overall yield. I built that retirement portfolio over the last couple of years, mostly at discounts to net asset value. It takes time, so a sound strategy and patience will get you there. I really like the last part of this comment where he talks about having a sound strategy and patience. You're not going to get there overnight. Anyone can get lucky once, but I think if you really are serious about building wealth, it's going to take time and patience. I think about my own experience when I was investing into real estate properties. It took me many years to be able to save up to buy the down payment to buy a rental property. It took me many years to understand what I was even doing, a lot of trial and error, learning by doing, and it didn't happen overnight. So if you're a new or a young investor and you're looking at this, just understand that you're not going to get rich overnight. You might get lucky once, but if you're serious about building wealth, it's putting together a sound strategy and being patient and working towards it. So I really like how he explains that here. Another comment here, I had a look at the quant and Seeking Alpha scores for suggested ETFs. The quant scores are low. Example, JEPI is rated a hold and SPHY is rated a sell. Can you elaborate on your recommendation versus quant scores? Why the discrepancy? And then Brett, the author, responds here that quant scores seem to normally have to do with momentum. For ETFs, I simply evaluate stuff that I would like to buy and hold, and in this case, have sustainable income. Quant, on the other hand, is very good for momentum in short-term and swing cases. Just depends on your investing strategy. Yeah, the quant scores on Seeking Alpha are really great if you're looking to trade the market, right? You want to buy something, you want to get in and then get out in the short term. If you're a long-term investor and you see the quant score down on one of your dividend stocks, that's actually something that excites me. At least it did when I was still working and buying stocks, right? Now I'm not working. I'm not investing any more money. I'm living off my portfolio. But when I was working, when I would look at that, I would see, okay, this is a high quality stock. Whenever you see McDonald's trading low and it has bad momentum, I saw that always as an opportunity to buy more, right? Obviously, you want to read into why it's down, why the quant is saying that it's low. Maybe it's trading at a premium, right? Maybe the price to earnings ratio is at a historical high, or the dividend coverage ratio or the payout ratio is low, right? So there's usually a reason for it. But if you're a long-term buy and hold investor, I wouldn't read too much into the quant. I would just see it as, okay, this is interesting, but I wouldn't let it deter you from buying into an ETF or a stock that you're interested in holding for the long term. In fact, it might actually be a good indicator that now's potentially a good time to buy, because it's not overvalued and you can get a higher forward yield and increase your yield on cost. So that's the article. Overall, I would rate this article an A. I think the article does a great job at explaining what he's trying to do here. He's talking about investing $100,000 in a high yield monthly dividend portfolio. I like how he talks about just investing in ETFs. I like the use case here if you were to sell a rental property or if you were to come into money, through an inheritance or wherever it may be, that and you wanted monthly income. This is a conservative way of how you can get a good balance of income and potential growth by combining assets or ETFs that are going to serve that purpose, right? Having an ETF like DIA with more growth potential, whereas you have maybe a high bond ETF or JEPI or JEPQ for more of the income today. And so whether you combine it with DIA or DGRW or anything in between, I like the approach that he outlines here. He's not talking about building a portfolio of 20 different stocks and BDCs and all that kind of stuff. I think he truly understands the reality of someone who doesn't want to trade one job for another job, right? And I just see that in myself. When I sold my rental properties, it wasn't because I wanted more work, it was because I wanted less work, right? And I wanted to have it be more passive. And so I think Brett hit the nail on the head with who he was addressing in this article. And I also really liked that he went into such detail when it came to the ELN strategy of JEPI and JEPQ. But yeah, that's the article. Thank you so much for watching. I hope that the video was helpful, and I'll see everybody in next week's video.